Hey everyone, it's Denise Donahue, your favorite mortgage nerd. Today is Friday. Woohoo! Happy Friday, everyone. And it is my weekly interest rate update. You guys know I'm dedicated to keeping you guys current about what's going on with the interest rate markets, what's going on with the bond market. Right now, I am on my website. You can go to my website and look at current interest rates and see my update rate video here, as well as how I shop interest rates for you guys. So be sure to check it out. I'm at yourmortgagenerd.com, and you'll just come here and click mortgage rates. So let's jump in. What happened this week? We had a lot that happened this week. You'll see here the most recent Freddie Mac report that was released yesterday. You'll see that the going rates for the 30-year are 4.45%, 15 years around 3.91. And then, of course, Len, the chief economist at Freddie Mac, gives a brief commentary every single week about what's going on. And what we know is that the Feds decided to increase interest rates by 0.25%. This puts the federal funds rate the highest level since 2008. Now remember, the federal funds rate increased multiple times last year, and as all my Nerd Club members know, the federal funds rate doesn't directly impact mortgage rates. It affects rates like your car loans and business loans and credit cards. But there is an indirect factor that happens, which is why when we look at the bond market, which is what I monitor for you guys, we can see here that, as you guys know, there's an inverse relationship between mortgage rates and bonds. What does that mean? Well, that's what we're looking at this chart. This chart here shows, this column here will show the price of the bonds, and then this row here shows the dates. So we can see right about here, which was towards the end of December, the bond prices were high, or hovering right around the 102 price point. Well, what's been happening is slowly it's been decreasing and pretty much hit rock bottom around here, around Valentine's Day, February 14th. Not so happy Valentine's Day. But when the bond prices are low, interest rates are up. That's why they jumped up 0.5 point. They've been hovering around the 4.5% rate. And then we've kind of been seeing this head and shoulders trend. And so they've kind of mellowed out a little bit, which is good news, but we're still right around the 4.5% range on those 30-year fixed. Yesterday, if I'm magnifying this for you guys, we had a pretty good day. Look at this. It jumped up a little bit. Well, what happened? Well, yesterday the Dow dropped down 700 points. And so what happened is a lot of that money flowed into the bonds, which is why we see this little bit of an increase. If I'm helping you with your mortgage loan, we'd be locking your interest rate right here, because this is a pretty good sign. So we locked everybody's rates in, but look how it opened up this morning, a little bit further down. That's because of all this federal funds rate. So making sure you're working with a certified mortgage planner that monitors this. This is what happens if you waited one day with locking your rate. So that's very important. Now, I do have a nice little treat for you guys. A lot of my clients are like, oh, I'm going to wait a year. Maybe I want to wait to save up some more money, or maybe I want to wait to see what's going on with interest rates. I wanted to show you guys this analysis. This is what I call the cost analysis on if you buy now versus waiting 1 year. So let's jump into it. This is the buy now section. So I'm assuming a $300,000 purchase price. I'm assuming a 3% down payment. That's going to give us a 4.625 interest rate, and it's going to give you a monthly payment around $2,300. Well, what happens if you wait just 1 year and the interest rates go up 1 full point, which is what all the economists are expecting? Well, if that happens, your mortgage payment is going to go up $179 a month if you wait just 1 year. But what happens if you wait a year and now that $300,000 home appreciates to $315,000? Well, that's what this column looks at. Now we've got that house is going to cost you $15,000 more dollars. That rate is going to be 1% higher. So now that makes your mortgage payment $297 more a month versus if you bought today. And I don't say that to scare you. I say that to keep you informed. That's part of my job, is to inform you on what the true cost is of waiting. If we analyze this over a 60-month time period, basically saying, okay, let's fast forward you in each one of these loan options. If you were to buy now versus waiting, it's going to save you almost $10,000 just if the interest rate went up. But what this is showing us is if the rate and the home appreciates $15,000, which in this area it's not uncommon, it's going to actually cost you $14,000 just in your first 5 years. So is it worth waiting? Is it worth breaking that lease now? Is it worth going ahead and buying the home with 3% down instead of 20% down? Well, it's going to save you about $14,000 because we can't go back in time and get you that better interest rate. So I know this is a little longer video than normal. This was just such an impactful video. I wanted to make sure that all of my clients stay informed, stay educated. Of course, if you have any questions at all, you are more than welcome to visit me online, where you can call us, email us, text us. You can even book an online appointment by clicking right here. We'd love to talk to you, love to start the home buying journey with you. Tomorrow, I'll be hosting a Mortgages and Mimosas. So if you're in the Plano, Dallas area, come see us at 11 a.m. tomorrow. I'd love to teach you how to get credit ready, mortgage ready, income running, get a savings plan. Would love to see you guys. So thank you and take care.